is a bottom forming. Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Andy Constan, the CEO and CIO of Damped Spring Advisors. Hi, Andy. It's great to have you back on.
Hey, Maggie. Good to see you again.
Well, we had some pretty wild market action to start the week. I mean, I think that's an understatement. We had a huge sell-off. We had a huge rebound. We had rumors, confusion. The VIX was briefly at 60. And even into the close here, we've sort of been rocketing around. Look like we might pull out. Nasdaq's positive now, which is down. I mean, it's going to be, as it settles here, kind of too hard to call, though that might look like it inched back into the positive territory. Where's your head right now as you watch all of this?
Yeah, I mean, it's basically, so there's two things, what's happening in the economy and what's happening to markets. What's happening in the economy is the direct outcome of the shift in fiscal policy in the United States and around the world as the Trump administration has taken office. And we entered that period of time with the Fed on pause, with bond yields at fairly high levels, enough so that they were tightening financial conditions, and equity valuations that depended on continued easing by the Fed, continued easy financial conditions, and an economy that was going to grow earnings at 12-ish%. And the Trump administration has decided, I think for sensible reasons, to make some major policy shifts, starting with immigration. They've reduced the labor supply growth by closing the borders. Totally reasonable thing to do, but it has a anti-growth outcome and an inflationary outcome. And then they've been working through, and it's still very early to tell where we end up with fiscal policy. We have DOGE trying to make meaningful cuts in expenditures, and we have the reconciliation bill that's still not passed through Congress, where the House has been clearly trying to cut expenditures and to be able to fund the extension of the TCJA, while the Senate seems less interested in that, and that hasn't occurred yet. And so neither the DOGE cuts nor the reconciliation cuts have really been turned into law. So that's still unknown and uncertain. We have the debt ceiling because of no resolve on the reconciliation bill that is still hanging over us and preventing the government from issuing. And then we obviously have tariffs. And, President Trump has decided, well, you have to take him at his word, has decided that he wants to correct the wrongs of the past decades where the United States lost manufacturing jobs. And I think his reasoning is sensible. One, I think there's a sort of a values question that the society somehow values manufacturing jobs over service jobs as something, I don't know, something just more has higher status, even if the wages end up being the same. And COVID and Ukraine and supply shocks that we've experienced has really shifted and the relationships we have with both enemies and friends has really shifted the balance from one that is our entire time here, my entire career has been all about globalization, and now we're in a deglobalization world. And it makes sense to, if you get your stuff from countries that may stop selling you their stuff, you need to be able to make that stuff yourself, even if you're not particularly good at it. And in order to do that, you have to make changes to the way trade works. And the Biden administration tried subsidies via the CHIPS Act, which increases the deficit to ensure chip supply. Trump has decided to use tariffs, which generates revenues, is a tax on consumers that brings manufacturing onshore. And so I think those policies are all anti-growth and tariffs are inflationary, at least at price level standpoint. Expenditure cuts are disinflationary. And they have this one last thing, which is deregulation. And deregulation is pro-growth and disinflationary. And they're trying to balance all these things. And right now we are in a period of time where most of the policy implications are anti-growth and inflationary. And that combination of things means the Fed's on the sidelines, which they seem to be, and the market has to adjust its growth expectations. And so bonds have rallied and stocks have fallen.
Yeah. Stocks have really fallen. So it all seems, I mean, you make a fantastic point, which is that, this was telegraphed, right? And there are threads of this from the first Trump administration. And, you can talk about this through a national security lens, and it makes sense. There have been some really fantastic conversations, and I've been sharing them that I've been listening to. And it's just like, oh, if you sort of pull the lens back, there's a lot of this that I don't want to say makes sense, but you can see the reasoning and you can decide whether you agree with it or not, but that there is this rebalancing that may have been necessary. Is the market selling off because it didn't take the Trump administration at its word, or they didn't believe this would happen? Or are they selling off because the way you go about doing that matters, and there is a loss of confidence or there are confidence questions about whether this is the right way to get to the ends? So the ends, the reason you may be doing it is right, but it's a very complicated chess game. And if you misplay your hand, a lot of bad things happen. And there's now maybe concern that they're misplaying their hand. Is it right? Is that why we're seeing this visceral reaction? Or is it just that they just didn't believe this was going to happen?
I think it's tough to say. I mean, I think that you have a school of thought in which I'd describe the art of the deal school of thought, in which threats were going to do the job instead of implementation. And that presumes that at any one moment, and we saw that even today, at any one moment, the policy is going to reverse. And so that tends to keep a bid on things. If you can have a tweet that says that, tariffs are going to be delayed 90 days, whether it's true or not, you have a 5% move in the S&P 500 in 15 minutes. That makes it very hard to be short the market. But on the other hand, it seems very clear that Trump is doing what he said. Now, in terms of the way it's being implemented, I sort of look at it at all administrations as being, struggling with implementation and struggling with communication. Yeah. This administration seems to be extra troubled by with that skill, but maybe it's also partly intentional. I've been spending most of my time paying attention to what Secretary Bessent has been saying, and he's been the same in every conversation. His talking points are exactly the same and consistent. Some of the others less so. And so I guess it's possible you have some implementation and communication problems, but I think it's much more that these are significant shifts in the way the United States approaches its business and its business with the rest of the world. And when you have major shifts like that, enough so that the Germans can decide to spend $1 trillion and break their long-held debt break, shows that, major things are happening. And when you have major things happening, you have increased uncertainty. So you have volatility increase, and you have dislocations of price across many different asset markets all at once.
Yeah. Does it seem, and we'll talk a little bit more about that, does it feel like we put in some sort of bottom for U.S. stocks, or is that a dangerous assumption to make? Because we saw that rocket rally when they thought the tariffs were going to be paused, and that seems to indicate a lot of people are looking to try to buy this right now. But I'm sitting here thinking, if it is this major shift you're talking about and others are talking about, that seems like a that seems like a very sort of risky thing to do. I'm not saying don't do it, but just that you should have a high tolerance of risk if you're looking to jump into what is a major reset of the world order.
Right.
Does it seem like this is the bottom, or is there a risk that there's a lot more of this to come?
So I don't think it's the bottom, but I also want to just step back and say the following, which is in January, I suggested that one should raise cash, and that means sell your assets and have cash. Over the Friday and again today, I've begun deploying some of that cash, not just in equities, but in bonds, in gold as it falls, in commodities, which have been getting destroyed, and in stocks. And I'm still underweight and significantly overweight cash relative to what I'd like to be normally. So I think it's still a period of time where you're probably better off having cash, taking rallies. If you don't have cash, using rallies to raise cash, because I think you're going to have an opportunity to buy all forms of assets at lower prices in the next few months. On the other hand, we've come a long, long way very, very quickly. And I've taken my more active portfolio, what I call my alpha portfolio, which is implemented by a hedge fund that manages it, and what I publish in my Damp Spring report, to a fairly neutral position. I'm slightly short, but I'm really prepared to respond to further dislocations. And so my short-term expectation is we probably put a bottom in today for the week, and then we run into earnings. And earnings are going to be actually pretty good for the first quarter. The reported earnings, they're going to be pretty good. The economy's been pretty good. But I cannot imagine a single CFO or CEO that would not take this opportunity to significantly tamp down expectations so that they can beat. Because we all know how uncertain the future is. Why pump your stock as earnings start getting reported toward the end of this month and into the following month? Then you also have an FOMC meeting. You have the Treasury announcing what it's going to do on its Treasury issuance. You still have the debt ceiling. You have the implementation. And so all of those things to me mean that, if we were to get I hate to use technical terms because I don't actually use technical analysis, but if you were to get something like a 50% retracement on this sell-off, I think it's a great sale, and I'll be leaning on it heavily.
Yeah. And that's what people have to watch out for, is that when you're in this period, this is, it just seems incredible to me that this would be it, and that everyone who's diving in, like if you're doing that, you have to know that there's a lot more volatility to come. Hey, everybody on Substack and in the chats, it's great to be with you. A lot of people are super happy to see you, Andy, and like, what do we do here? We need help. How are we thinking about this? But other people looking for opportunity and taking some as well, which is interesting. A lot of questions right now about the Fed. Is the Fed going to inject liquidity? We've got a couple of those. What is your thinking about the Fed here? You mentioned they're on the sideline. Looks like that's where they want to stay. What would happen to change that? Like, what do you think that they're looking at?
So I think, when I say they're on the sidelines, it's likely that it's almost certain that they're going to pause in May again. And then it's possible, depending on the way the data plays out, we've got some inflation data, which isn't going to be attractive, and all of the other data that they're going to get between now and May, with one jobs report, I guess, is going to be okay. So they're not going to be, the data won't give them any cover to be dovish. It'll be inflationary. It might be a little weaker growth, but not much weaker. And policy may still be in flux. If tariffs have been implemented on the 9th and are running come the Fed meeting. Perhaps they're going to be more clear about what they think inflation will be like and give guidance, but I don't expect them to be particularly dovish. On the other hand, if the data were to turn over very quickly, remember, we're just talking about May, right? It's not that far along from now. If it were to turn over very quickly, I could see them guiding to more cuts than they have today. They've guided to 50 basis points of cuts in 2024 and 2025, and a terminal rate around 3.25. I could see them being more dovish if the data were to turn over. But lastly, there's always the possibility when you have these market dislocations, particularly when financial institutions are highly levered. Now, banks are not particularly highly levered. In fact, they're very unlevered relative to almost any other time in history. And corporate balance sheets at the macro level, are in fantastic shape. So I don't expect a credit crisis, but you never know when you can have a blow up of some sort. And in that case, they might act in various ways. The one thing I don't think they will do under any circumstance, until there's a significant slowdown in the economy where inflation is clearly dead and unemployment rate starts going well above 5%, they will not have cut rates to zero. And if they haven't cut rates to zero, they will not be doing any large-scale asset purchases, which is the definition of quantitative easing. On the other hand, if some banks get in trouble, are they going to aggressively use their discount window and standing repo facility or any other program they use to save these banks from crisis? Yeah, of course. But that won't be the sort of QE that most of your viewers are thinking about.
Yeah, and we saw them move really targeted with Silicon Valley Bank and sort of circle the wagons and try to isolate that when it happened. So, they've got the playbook for that. We saw Treasury yields moving higher. Is that what is that telling you, and what are you watching in the bond market?
Right. So, firstly, let's step back and say that a week ago, there was a little bit more than that. There was an expectation that the Fed would cut only 50 basis points, which is what they've told us. Last night, the pricing for December of this year was for 150 basis points of cuts. So a radical shift that represented strong demand. Not the Fed didn't say anything. So it represented market participants saying, I have to own cash-like instruments. Why? Because they were in a massive risk off. Now that 100 basis point drop in yield in the front end obviously caused the back end to rally as well. And there was some demand for anti-growth assets because we're in an anti-growth environment. And so long-term bonds rallied quite a bit. The curve steepened, but long-term bond yields rallied such that 10 years dropped below, I think we're 388 at one point. And there's no reason for bonds to be at those yields. You have to actually have the slowdown happening for bond yields to be at those levels. And so first, the bond market started to sell, the long bond market started to sell off again, real yields rising again. And then the STIR market fell as well to a point where now there's only a little more than 3 cuts, almost 4 cuts priced in. And I think it's more about the sell-off in the bond market today, which is getting all sorts of conspiracy theories thinking that this is a hate selling from Chinese and Japanese and international official sectors who want to get out of U.S. bonds ahead of any potential risk that the bonds get either are selectively defaulted upon or taxed, or they just don't like what they're using the capital account to fight back on the tariffs. I think that's all mostly nonsense. There's no evidence of that. What I think is happening is the front end got crazy bid based on risk off. It dragged the back end to an unsustainable level, and the back end finally both came in as the equity market stabilized. And if you look at bond yields, they are unchanged in the last 4 days. They went down a lot, and then they went back up to unchanged. So I'm not a believer in this, the Chinese are dumping our bonds theory. And I have good reasons for that, knowing what they tend to buy, how they tend to buy it, and their actions over the last 5 or 6 years in terms of running off their balance sheet. Lastly, what I think is much more interesting, however, is with China stimulating fiscally and monetarily, Japan having an economy that's working pretty well and a relatively easy policy, alleged accommodative policy, with Europe entering into a never before fiscal stimulus. Capital should be going home, away from the US, who has constricting its fiscal policy and has relatively tight monetary conditions. If I was a dollar, or if I was a currency, I'd want to go where it treats me well. And the US is not that place. So I actually think, and by the way, US equities in particular are massively overweight the market portfolio globally. And so it's pretty easy to begin to, once they stop going up, it's pretty easy to start to want to, and you have all these monetary and fiscal consequences, it's pretty easy to say, let's bring some of our money home.
Yeah, I'm so glad you brought that up, because that is when I see people thinking that this is a dip to buy, that doesn't seem okay. Maybe the tariff tantrum, say it's over, say that was it, but you have that other massive story in the background, which is this allocation out of the US back to the rest of the world, which everyone was talking about before Liberation Day kind of threw things up that's still in place. Isn't that sort of a constant negative for the market, or a constant sort of selling pressure for the US if there is a major reallocation?
Sure, but it also is everything's dependent on price. Like, saying that at 6,100 was a lot more interesting to me than saying it today. Saying it today, some of the overweight of global equities, of US equities, has come down because of price. Like, if you had 70% of your portfolio in US equities, you don't anymore. So some of that happens due to price, and you always have to look at price. And what I would say broadly, and as I said, I'm beginning to put money to work in my beta portfolio, is we are correcting in price, and that changes the whole value dynamic. The question for me is really, are the monetary and fiscal policies going to get more difficult for US equities, or less difficult for US equities in the coming days and weeks and months? To me, there's been a lot thrown at US equities, and there's a lot more to come as it relates to companies potentially having to slow their hiring or start firing workers. Earnings expectations, which have yet to be revised down, become revised down. So I think there's a lot of negatives on the stock market. But as I said, right this moment, I'm fairly neutral. I just think it's a great opportunity to sell a rally. But the next one might be a pretty good rally.
Yeah. The sort of, tried and true has been to step in and buy what's the most beat up. And boy, Mag 7 is certainly a poster child for that. When you're talking about looking for opportunity, it sounds like for a tradable rally, at least. Is Mag 7 part of your, how do you decide where to deploy that?
So for me, I'm just an index guy. I don't really I'm not particularly good at sector, I traded single names for half of my 40-year career, but don't do it anymore. So I can't really help in terms of where to go. But in terms of the indexes, I think we've had a meaningful dislocation and are due for some bounces in those things.
Steiger is asking thoughts on credit spreads as stress signal.
Yeah, my belief on credit spreads is they move along with the combination of two things: the level of equities and the implied volatility of equity options. And as you probably know, equities have gone down a lot, but very recently, volatility has also gone up a lot. Maggie mentioned the VIX. You look at pretty much any measures of implied volatility, they've gone up 40 odd percent from, the low 20s to the mid 30s in terms of tradable VIX futures. That tends to cause, because it happened all of a sudden, it tends to be coincident with and drives increases in credit spreads. And you've seen that. At the same time, there are sectors of the, credit is a very idiosyncratic animal. Not all companies issue corporate bonds. Microsoft, Amazon, Apple, if they issue corporate bonds, it's a tax dodge. It's not because they need the money. So you have a set of constituents that are very different than the S&P 500 constituents. And you have to look in more depth. But by and large, the high-grade credit market is in extremely good health. And so ultimately, you see level and volatility increase and credit spreads widen. It's pretty rare that they're then followed by defaults. So I think just like assets are getting more interest, stocks are getting more interesting, credit spreads getting more interesting, and it's following its normal behavior. Now, if you start talking about triple C's or CLOs or some of the lower grade tiers of credit, that's where idiosyncratic information is going to be dominant. And, I'm sure there are many, many landmines in that space.
Yeah, that's a great point, by the way, especially about some of those big companies who took advantage of really, really low interest rates, and it really didn't have anything to do with needing the money so much. When we're looking at, you mentioned sort of looking for opportunity, and there's been so much attention on what's been happening with equities, rightly so, because so many people have exposure. Most of their exposure is to that in their 401. We've seen massive moves in oil, as you pointed out, in energy. Do you think we're on track? Is Scott Bessent going to get his lower oil, lower dollar, lower interest rates? Is that going to pan out for him? And what are the implications for investing if it does?
Well, I think so. Well, he certainly is getting,
for the moment, right?
In terms of yields are coming down. The dollar is not rallying despite tariffs as it normally would. And energy is coming down. And you have to look at the root causes of that. Energy is coming down for probably two reasons. One is this growth slowdown that's driving lots of growth assets. Demand is likely to fall as economies slow due to the Trump policies and the retaliations to those policies. So that takes the legs out of demand. On the other hand, supply seems to be, the most recent OPEC meeting seemed to be fairly willing to help the inflation dynamic by increasing supply. And so that combination is pretty toxic for oil when demand is falling out and oil and supply is increasing. How far it goes, that's a different question, but I'm not catching a knife in the energy market at this stage.
Yeah. It's easy this week, I feel like, and the end of last week, as we start this week, we have all of these concerns about having no certainty. How can anyone do any CapEx? We're headed to recession. We're in this untenable situation where the slowdown is going to be so rapid. A lot of people sort of, screaming about the potential risk, which makes sense. Are we underestimating the possibility that Bessent's 333 may end up juicing growth? And, had a video making the circuit today of Elon talking about He thinks there should be a free trade zone with Europe, and somehow things get negotiated, and we have the unexpected result of maybe having way less tariffs across the board. Like, are people underestimating the possibility of this going right? Because it's so easy to be so stressed by all the inherent risk in this massive reordering.
I don't know if they're underestimating it, but let's start with Bessent. I mentioned the interest rates are coming down. The oil is coming down. His 333 is oil coming down, which is 3 million barrels equivalent of energy produced in the United States. That can happen. It's going to be tough for oil to be produced in the United States at this price. The other is a deficit of 3%. And we're nowhere near that. Like, nothing is like that at all. There are no expenditure cuts and there are tax cuts, and we can't get expenditure cuts passed into law. And DOGE is doing what it's doing, but hasn't memorialized any of those things into actual legislation that can actually cut the budget. So I don't see anything like a 3% deficit. Now, he wants to go in that direction, and that's fine, but we're not going in that direction. If we were to go in that direction, that would be very heavily anti-growth.
Exactly.
You can't, no matter what the deals are, if you reduce the deficit and you do it by reducing expenditures, or taxing more like tariffs, you slow growth. And the other three he has is 3% real GDP. And that's a very high number when you are, you've essentially eliminated population growth. It's a very heavy ask to lean on productivity. Now, productivity is driven partly by deregulation. And so it is possible that what we're going to get is some massive deregulatory state that provides 3% real growth. I don't see how it all comes together. I do believe that there are going to be all manner of different outcomes from the trade war. And I believe that people are, if anything, until 3 days ago, placing way too much hope that we were going to get a painless elimination of global tariffs by threats. It doesn't look like that now. And I don't think it's being I think it's still being discounted that that's a possibility, because it was already heavily discounted, and now the reality hasn't really gotten people to say this is not just a bluff. But you're right. But that doesn't really matter, because if what you said is true, it's going to be very good.
Right.
But the odds are still priced into markets. And so we have to know that it's good for us to expect the economy to respond and markets to respond. And right now, it's nice to be able to say whether you think a head or a tail is going to come up. But until it comes up, you're just guessing.
Yeah. You've been doing this for so long. Can you remember a time that there was this much uncertainty? I mean, you sort of macro guys kind of thrive in volatility and to a certain extent uncertainty. Are there any parallels for you that you've done?
In my personal experience, there was, I think, the period of time in September of 2008 was probably far more uncertain. In terms of what was going to happen with policymakers and their actions. Certainly COVID was heavily uncertain. I look back to long-term capital. That was uncertain for a brief period of time.
Yeah.
And there was a fair amount of uncertainty in the 90s, but it doesn't really compare to the uncertainty of the things I just mentioned. But yeah, I would say it's a fairly uncertain time.
Yeah, it seems to be. It seems to be. in a way that maybe because the center of it is, or there seems to be uncertainty without much collaboration. I felt like during the financial crisis, there was a lot of people working behind the scenes together to keep the wheels on. And this time it seems a little less like that, but we'll see whether that changes. That's one of the unknowns out there, right? One quick thought about gold before we go, because we have some questions about that. That's going down. I don't think terribly unexpected. People have to liquidate their winners, right? When they're trying to cover themselves. But is that a spot where you see opportunity, or is that kind of caught up in this uncertainty?
Yeah, so I'm always long gold in my beta portfolio. I added gold Monday and yesterday and today. I'm happy it's coming down in price because then I can buy it. I think it had made a tremendous run that from an alpha standpoint, I had no idea. I wasn't going to stand in its way, and I certainly wasn't going to jump on. Because I didn't understand why the gold market was rallying while real rates weren't.
Mm.
And I think that has to do with the de-dollarization of some investors. But no, I don't really have a strong view except to say that I'm glad I own it. I'll always own it. It's something to own.
Yeah, absolutely. What are you going to be watching for? What's important? What market do you watch when you're trying to sort of key in on, sort of eliminate some of the noise? Some people have been looking at credit spreads. What is it for you? What are you most paying attention to? Is it bonds?
It's really not it's hard to narrow it down. I try to look at so many markets all at once. I think when you focus on the markets, you tend to get a little bit myopic on what's happening in the markets. What's been suiting me well for the last few months in particular is focusing on the policymakers and what they're doing. And so what I'm looking for is I'd like to understand what's going to happen on the expenditure side, but that may take many months. We may be until the August debt ceiling default day that we call X date before we have a budget. We may never see DOGE cuts memorialized in law. I'm focusing a lot about that because I think the tariff stuff is actually a bit more noisy. Don't get me wrong, it's important, but it occupies so much of the current market thinking that I'm trying to look to the next thing. I don't expect immigration to change. If it were to change, that would be something. And then I mentioned deregulation. So far, we've only seen what I would call financial system deregulation. We haven't seen broad deregulation of global production. So I'm looking for that as a potential for a boost to productivity. And then the Fed, eventually the Fed is going to cut rates. And so paying attention to when they begin to get comfortable with the policies, seeing what they're doing. But then I guess lastly, it's price. What's priced into markets? And right now, at an 18 PE on $276 EPS for the S&P 500 next 12 months, it's certainly not as expensive as it was, but that $276 of earnings is highly vulnerable. So it's interesting, did the PE fall already account for a decline in earnings? Maybe. But what is the trough PE supposed to look like before the earnings roll off? And then, of course, the earnings themselves and their guidance. But as I said, I think those are going to be pretty pessimistic by design.
Yeah, when we're in a situation like this, you get it all out, right? It's probably going to be like super negative so that you sort of cover yourself totally, throw the baby out with the bathwater type of situation. So,
yeah.
Andy, so great to catch up with you. We need the experience and wisdom now because there is an awful lot of chatter out there. So we really appreciate getting your perspective today.
Thanks for having me.
Appreciate it. Just a programming note, everybody. I mentioned we're going to do 5 days this week. Did I mention this already? But we're going to have Coach Dale tomorrow. And we're going to be popping up on Substack for all you Substack folks, in the mornings with some updates. We're going to do JJ, who writes Market Vibes on the Alyosha Substack, to give us a little trading update. So keep your eyes peeled for them. If you're not on the email, or follow me on Twitter or Substack, we'll let you know when that's coming up. And then we'll have Coach Dal here tomorrow to talk about some levels, which, by the way, he called, much like Andy was talking about raising cash. Dal was also flagging some of his concerns. So it's always good to sort of make some notes when you're listening. So appreciate you all. Andy, good luck for the rest of the week. Thank you so much. And everybody out there, take care and good luck.